Hey everybody, welcome to Chipstock Investor. Just Nick here with you today. No, the band has not broken up. Casey's busy working on some other projects. You'll see her flying solo later this week, doing some intuitive surgical coverage. We're just experimenting with some different video formats to get some content out to you in a more timely fashion here during earnings season. I'm going to be talking mostly about Meta in this video, a little bit about Microsoft, and the supposed AI bubble that this conversation keeps coming up in the media. I'm going to explain why there is no AI bubble, at least not yet, and what the key indicators are from Meta and Microsoft earnings that indicate potentially more good times ahead for chip stocks like Nvidia and Broadcom. Yet the DeepSeek news, just a big giant distraction. And then finally, Meta stock. Is it still a good risk reward stock to buy? Just kind of revamp what we're looking at on this, because you may have seen about a month ago when we talked about our portfolio, Meta was in the top portfolio holdings. So before we launch into this discussion on Meta, Microsoft, and Nvidia, a word from the sponsor of today's video, public.com. If you're serious about investing, you need to know about public.com. This is an online broker where you can invest in everything all in one place: stocks, options, bonds, cryptocurrency. And we've had some turbulence in the bond market as of late. So if you're looking for a place to stash some shorter term cash, the new bond account at public.com could be a good fit, where you can lock in a 6% or higher annualized yield. Public.com is FINRA registered, SIPC insured. Fund your account in 5 minutes or less at public.com/CSI. Link in our video description below, and get up to $10,000 when you transfer your old account. That's public.com/CSI. This ad is paid for by Public Investing. Full disclosure in the video and podcast description. Okay, let's get back to our discussion on Meta. Let's talk about this. I want to define just a couple of key terms for you here. Firstly, if you want to just pause on these two slides here, a couple of key definitions for you: a server, data center, accelerated computing, and AI, which is just one particular workload for accelerated computing. And then the difference between existing data centers and enterprise computing infrastructure and new data center infrastructure purpose-built for AI. Take a look at this before you continue on in the video if you need some help with this terminology. Let's address key point number one, the AI bubble that's not really actually a bubble at all. Here are a couple of key points that Meta made in its Q4 2024 earnings press release. The first one they'll highlight here: capital expenditure, including principal payments on finance leases, nearly $40 billion spent on CapEx for full year 2024. What is CapEx spending? It includes spending on data centers, so that's the building itself, and then servers. So those are the computers, essentially, very large, powerful computers that sit inside of the data center that power things like the cloud, or in this case for Meta, a very particular end product. And for Meta, that would be Facebook, Instagram, WhatsApp, and all of the other services that you find in there, like Reels, the short form videos that you see in Facebook. So CapEx in 2024 of nearly $40 billion. They're expecting something in the order of a 50% increase in CapEx in 2025. You see in point number two, 60 to 65 billion in CapEx is expected in 2025. This sure sounds like an AI bubble, right? If Meta and the other big tech giants like Microsoft, which we'll get to here in a moment, Google Cloud, Oracle, spending all of this cash on AI servers in their data centers, 50% year-over-year increase certainly sounds like a bubble. However, notice at the end of point number two here, it says the majority of that CapEx in 2025 will continue to be, important point there, continue to be, so this has already been happening all along, directed to our core business. And for Meta, of course, that core business is Facebook, Instagram, and WhatsApp. Most of this CapEx, of this infrastructure, including a little bit of AI infrastructure. They don't tell us how much is specifically AI infrastructure, but it's a small amount. Most of the CapEx is going to Meta's core social media apps and the advertising revenue that pays for all of that. Yes, that's right, folks. Unbeknownst to most investors, Meta is one of the world's most powerful computing businesses on the planet. They have data centers all over the world, most of them in the United States, a handful in Northern Europe, one in Singapore. You can see this on the map here. Every data center is one of those little Meta logo icons on the map. And we highlighted this so-called AI spending bubble back in July of last year. Link the video that we did on that in the description below. But what is actually happening here is during the bear market, a lot of companies, Meta included, pulled back on a lot of their expenses that were out of hand after the pandemic. And they were taking stock of where they wanted to spend next. And then this little company called Nvidia launches some new accelerated computing equipment for data centers. And so you see the pause in CapEx here for Meta from 2022 to 2023, a sizable, roughly $4 billion reduction in CapEx from 2022 to 2023, as they kind of take stock of where they want to allocate new capital. And then you see that CapEx re-accelerate in 2024 as they figure out, hey, NVIDIA's new accelerated computing systems are really great. Yes, they're great for training new AI models, including Llama 4 that Meta has been working on, but the bulk of this accelerated compute is just working on Meta's infrastructure for the existing social media business and the ads that pay for those social media services. So the question then becomes, how in the world is Meta going to fund this out of control so-called AI CapEx, going from 40 billion in CapEx in 2024 to an expected 60 to 65 billion in 2025? We could ask a similar question of Microsoft. You can see in their recent quarter that just ended at the end of December, Q2 fiscal 2025 from Microsoft, additions to property and equipment. That's another phrase for CapEx, for capital expenditure on data center buildings and the servers that go into them. Again, another 50% some odd increase in CapEx year over year in the quarter to almost $16 billion. How is Microsoft also going to pay for that? Well, the answer is quite simple. It's the same as for Meta. Microsoft already has a very large existing business. Most of this spending isn't for new AI and some AI bubble. Most of it is for an existing business that needs to be serviced. In this case, Microsoft Cloud and Microsoft Azure, which collectively just surpassed $40 billion in revenue, according to CEO Satya Nadella on the last earnings call. A 21% year-over-year increase for a business already this big, 40 billion plus. That's incredible. All of those cloud software services have to operate on something. It has to run in a data center somewhere. And if it's growing that fast, Microsoft has to expand that capacity to address that customer demand. And why not use accelerated computing systems if it's getting the job done more efficiently? Yes, also there's some AI there. Nadella said that their AI specific business is now at an annual run rate of $13 billion, up 175% year over year. So AI is part of this story. But as these big tech companies, I think they've finally begun to listen and explain this in a bit more detail so that investors and analysts on Wall Street get a better picture of this. AI is only part of the story. You can see CFO Amy Hood explaining this in more detail, that most of the CapEx so far in fiscal year 2025, which will go through the middle of calendar year 2025, is long-lived assets. So a lot of this is just the actual data center building itself and related power delivery infrastructure. And then by fiscal year 2026, they still expect to continue growing their CapEx spend, but it will shift towards more short-lived assets, which would be things like servers, like GPU powered servers from companies like Nvidia. But still, you may be asking, a 50% year-over-year increase in CapEx, capital expenditures, especially Meta, 60 to 65 billion in CapEx. That's wild. How sustainable is that really? Well, remember, capital expenses, like any type of expense, is cyclical. So at some point, Meta will kind of pare back its spending on CapEx. It doesn't look like it's going to be 2025. But in the meantime, how do they pay for it? Because of this new equipment that they're installing into their data center infrastructure, the accelerated compute systems from Nvidia, check out the average price per ad growth that Meta has been able to generate. 14% year-over-year growth in the average value Meta gets per ad on Facebook, Instagram, and so on. And then pairing that with this incredible chart. Look at Meta's expenses as a percentage of revenue. So even as they have grown their ad revenue as a percentage of that revenue, their expenses have continued to fall. You can see the decrease there year over year again in Q4 2024. The general cost of revenue down 1 percentage point, R&D expense down 1 percentage point year over year, marketing and sales, you name it, across the board, more valuable ads and lower expenses. Meta's basically saying, you know what, for the time being anyways, out with the human workers, in with the accelerated computing machines. This is profit margin expansion. Meta is demonstrating for us the incredible return on investment these large data center companies can get by utilizing Nvidia accelerated computing systems. On the earnings call, we did get one example of what exactly Meta is doing with some of this new accelerated compute that they're getting from Nvidia. CFO Susan Lee called out the build out of Andromeda, which is a much more efficient ad delivery system, a 10,000x increase in the complexity of models Meta uses for sifting through the many millions of ads creators are putting out there, that marketers are putting out there on Facebook and Instagram, and then filtering those down to just the most relevant few thousand ads that they think the user of the app would find most relevant to them. So these models are very complex. The parameters that they use to filter through those ads and deliver the right ad to the right person at the right time are getting increasingly more complex. And the benefit to Meta is, like I just showed you, the increase in ad value and the lower expense along the way. Incredible operating leverage for a company like Meta. So to sum up the first 2 points here, there is no AI bubble here at all, at least not yet. When we get the earnings reports in the coming weeks from companies like Amazon and their commentary around AWS, as well as Alphabet and Google Ads, Google Search, and especially Google Cloud, we'll take all of the commentary we get on their capital expenditures and put together some more charts for you and update that video we did on the truth behind the AI bubble and capital expenditures among big tech. Stay tuned in the next couple of weeks. But the point so far, there is no AI bubble. This is just very large tech businesses supporting the very large revenues that they already have. And then point number 2, Meta and Microsoft, key indicators for chip stocks like Nvidia, like Broadcom, and others in 2025. It looks like 2025 at this point, it's going to be another good year for those semiconductor businesses, especially accelerated computing. Final point, Meta. Is it still a great risk to reward investment? And I think this is an important question to think about if you own Meta stock already, as I think many investors do, either via an index or if they just own Meta stock outright. There is definitely risk here, especially in these CapEx cycles where you see numbers like a 50% year over year increase in expenses. These are very large numbers. Let's go back to these key points I pulled from Meta's earnings press release. Point number 3, let's just talk about the useful life of these expenses that Meta is making into their data centers and into the servers that operate their applications and the ad business and some of the AI algorithms as well. In the past, it was very common for a data center server to last about 4 to 5 years. And then it needs to be refreshed. It needs to be replaced with the newest, latest, and greatest system. Something interesting is beginning to happen here, especially with NVIDIA's GPU systems. Yes, they're ridiculously expensive. Some of these servers costing tens of thousands of dollars each, and these companies are trying to cram tens of thousands of these GPU servers together into big giant clusters of GPUs to operate these really, really big AI models that do things like deliver the right ad to you. As they're putting these into service, though, you notice here that Meta is going to increase the estimated useful life to 5.5 years. So this is an additional reason why a lot of companies are making the switch to accelerated computing. It sure sounds like where before a CPU-based server from Intel or AMD, maybe its useful life was 4 or 5 years, and you had to depreciate that cost over 4 to 5 years. Meta is now putting these new accelerated computing systems to work, and their useful life is maybe 5 to 7 years, and the expense gets depreciated over a longer period of time. Why would the useful life be longer? There's a lot of talk out there about NVIDIA's dominance in AI training. And as we move into the stage where AI inference starts to happen, so the model has been trained, it gets put to use, like let's say in an actual piece of software, and built in that software is an AI chat function, let's say, or an AI rendering engine for audio or visuals. Companies like Meta might buy the newest Nvidia equipment for AI training, use it for training for a year or two, and then rather than retire that equipment when the newer system comes out, like let's say Blackwell this year or Rubin perhaps in 2026, all Meta is doing is they're taking the older system, the H100s and the H200s, and then they're just going to retire them from training and start using them for inference. And the big news surrounding this in the last couple of weeks was, of course, DeepSeek and the big breakthrough that they made with their AI algorithm, needing just a fraction of the compute versus like OpenAI's ChatGPT. What does that mean for the inference market? It sure sounds like nobody is going to need all of those NVIDIA servers anymore. Not the case. Meta is still going to continue training new AI, both for its existing business and the smaller, newer AI business as well. And who's going to win the AI inference race? Because NVIDIA is selling all of these systems with an extended useful life, 5 to 7 years out into the future. AMD getting in on this as well with the MI series, Broadcom and its custom accelerator business. The useful life for inference has been extended. And this is exactly what is supposed to happen with any new tech. The performance rapidly increases the first couple of years. And in tandem with that, the price to compute, the price of that technology also rapidly declines the most the first couple of years. This is known as Jevons paradox. Put the link to the blog article we put together explaining this more in depth. Because of the rapid increase in performance and the rapid decrease in cost, new AI models start to proliferate and help make the companies that put it to use more efficient, more profitable. So could it cause some bumpiness for NVIDIA and the other chip stocks? Yes, it could at some point, but this is ultimately fantastic news for a company like Meta that's getting the better performance and lower cost of this technology. So we've also talked about in the past how if you own NVIDIA, a nice kind of built-in hedge would be a stock like, for example, Meta, or vice versa. If you own a stock like Meta and you're worried about elevated capital expenditures for a time, hedge against that might be, for a time, owning also NVIDIA stock. So at this point, Meta still looks like a pretty good risk to reward investment as part of a well-diversified portfolio. If you're worried about what happens to NVIDIA, is there some turbulence at some point as some of the big hyperscalers decelerate their CapEx spending? Meta's going to be a fantastic beneficiary and kind of a counterpoint, if you will, to NVIDIA, and vice versa. And if you look at the valuation of Meta, both in the next 12 months and over the course of expectations for the next 2 years or so, the PEG ratio well under 1.0, which tends to signify something is undervalued. So even though Meta stock has increased quite a lot since the bear market in the last 2 years, is it too late to own Meta stock? For us personally, the answer is no. We're happy to continue holding this one. But of course, it emphasized this. We have a lot of different stocks that are exposed to different parts of the economy. They participate in different industries. Diversification is really about getting exposure to different businesses that will behave differently in different economic climates and as the economy kind of changes and evolves as the years go by. So is Meta a good value? In our estimation here at Chipstock Investor, I think we would simply say yes. In our estimation, it is still, even at this point, a good value as part of a diversified basket of different companies that participate in different industries and in different parts of the tech supply chain. That will do it for today. Later this week, we will be publishing a conversation we had with Jeff and Jason over on Investing Unscripted on DeepSeek, the aftermath of that and what it means for investors. And then, as I mentioned before, Casey will be flying solo, and you'll see her in a video outlining what happened with Intuitive Surgical to close out 2024 and expectations for 2025. Hit the subscribe button, hit notifications, and of course, check us out on Semiconductor Insider. Our membership there is where you'll find all of our research in one place and our most up-to-date thoughts on the businesses we research and invest in. Catch you all again real soon.